Right. With that assessment of the SPPI test, let's now talk about the business model. Right. What is a business model? Basically, business model is a level at which a group of assets are managed to achieve a particular business objective. It does not depend on the intention of one single individual instrument. You have to look at it at a higher level of aggregation. Also, you do not factor in stress case or worst case scenario. So for example, when you made an investment, you don't need to think, if there is a pandemic, I will have to sell all my investments to generate cash. That's not how you assess. That way, everyone will have to liquidate instruments. Right? So don't look at stress cases. Look at something that is reasonably possible. Now, let's take one example and discuss this. There are many large companies which have a very active treasury. Basically, what that treasury does is it says, if I have surplus money, I will invest in government securities. It's safer than bank. It is more liquid. I can sell off those whenever I need. Right now, the business model of the government securities is basically not assessed at one instrument. So it's not Government of India's 7% debenture 2025. You look at the pool of instruments together. And you look at it as an entity, how do I manage all my government securities together? Right? So it is a higher level of aggregation at which you have to assess. I may have a view that short-term interest rates may go down. Therefore, I am going to only buy long-term instruments. Let that be a different business model. That's not how it works. Individual intent does not matter. Very important, it is basically how the key managerial personnel in the entity look at it. Therefore, you have to look at it at a higher level of aggregation. Also, one entity can have more than one business model. So for example, you can say government securities held to collect and sell because I may need them for liquidity. But company FDs, if I am investing, or if I am investing in company bonds, say tomorrow, again, say Tata Capital comes out with an NCD issuance, that is held to maturity. I will not sell it. The business model could be different for bonds, could be different for government securities. So one entity can have more than one business model. You could also have different business models within one product. See, a lot of this, what we're speaking right now, may be more relevant to a financial services entity, but I'll still take you through the concept. So let's take an example of a bank. Say ICICI Bank. ICICI Bank gives home loans, personal loans, business loans, project financing, infrastructure lending, and all kinds of products. As a bank, they say, personal loans that I originate, I will go and sell them to other banks because I want to refinance my asset. But term loans or infra loans, I will keep them till maturity. You can have two different business models as a bank. One business model for infra loans, one for personal loans. Similarly, you could have auto loans where you say, no, once I've given the loan, I will keep the loan with me. Let the natural repayment happen. That again could be a different business model from infra loans and from personal loans. So you could have sub-portfolio loans. All loans are not necessarily in one basket. You can stratify the loans or the portfolio of loans. But don't go to loan level assessment saying loan to Pratik, an auto loan taken by Pratik, I will sell it down. He's not a good customer. I will sell it down. That's not how you assess. So this again is extremely judgmental. And therefore, I think we must take a few examples to assess. One of the common guidance is basically for something to be FVOCI versus amortized cost, you look at the frequency of the sale, right, and the value of the sale. And I don't know if you all remember, but about year and a half back, ICI came out with a FAQ on this. And the FAQ was also unfortunately not very prescriptive. It says volume or frequency is rare and volume has to be negligible. It did not define any of those. So basically the standard here introduces an element of judgment. It says for an FVOCI debt, if the objective of business model is collecting cash flows and sales are integral, that's FVOCI debt. Versus amortized cost, where you only collect cash flows to maturity. Sales are incidental. Sales never form a deciding factor of how you manage the business. I gave a loan, I originated a trade receivable, that's it. No further assessment, I am not going to do any more analysis. Now, frequency of sales and volume is, in an FVOCI debt, you will naturally expect more churn, more number of transactions than you would see in a amortized cost portfolio, because the objective of the portfolios are different. An amortized cost portfolio necessarily means you will hold it to its maturity, isn't it? So that's where there is a difference in how do you classify. There are no bright lines. This is an area of judgment, but the standard does give some instructions or some instances of how one should evaluate this. Basically, you look at how does management or KMP look at this business? What is the relevant and objective evidence of a business model? How does performance of the business model be evaluated and reported? Some of this, once again, relevant to a bank. In a bank's treasury, you will have 2-3 different roles or different people doing work. For one person, his role or his objective is only to trade and make profits. His bonus also depends on how much profit he makes for the bank. Sorry. His bonus also depends on how much profit he makes for the bank. That business model cannot be FVOCI or FVTPL or amortized cost. It has to be FVTPL. Right? What are the risks that affect the performance of the business model? How is that managed? So for example, in a bank, you have one person or one team that only does liquidity management. They will just ensure that the bank never runs out of liquid cash when a person comes to encash his savings deposit amount. Here, his objective is liquidity management. It is not holding those assets to maturity. Therefore, the business model is FVOCI. Yeah, we spoke of how compensation happens. And finally, what is the frequency, volume, expectation of sales and future activity? So the more frequent the sales, the more regular the sales, the greater the sales, the more the assessment goes to FVOCI. The fewer the sales, and the more you hold the money or hold the loans, amortized cost is the answer. So in a traditional services manufacturing entity, maybe not too critical a decision point, but if you're an NBFC that is applying Ind AS, this is an extremely important one. Securitization portfolios, assignment portfolios, they will all come into question, or they will all call the business model into question. And to recap, the relevance of this is, if you conclude the business model is FVOCI, remember I have to fair value my loans. Now imagine a bank or an NBFC having to fair value all its loans every quarter. So it's an operational challenge, it's an audit challenge, and it's an area of judgment.